and welcome to our investor presentation. We're going to be hearing from one of our investments here from Group RMC. My name is Chris Martin. I'm the lead wealth advisor here at Friesen Capital Management, and I'm joined here today from Anthony Gunari. And so Anthony is the senior vice president and a partner at Group RMC. And his primary role is really fostering the relationships across Canada within investment advisors like myself, but also working with family offices, so across the nation. But also Anthony, he has over 15 years experience working within that financial sector. Previously, he was a regional sales director of Desjardins Wealth Management, where he developed a lot of his business investments knowledge, but also worked with portfolio managers to bring investment products such as ETFs to market. So prior to Desjardins, Anthony was also doing a lot of business development for Manulife Investments, where he worked alongside investment advisors and their clients. So Anthony, thanks for joining us here today and taking time to provide a lot of our family's quarterly update and what's going on with Group RMC.
Thanks,
So
Chris. It's an honor to be here.
absolutely. So I know what we're going to be covering off here today is we're really looking and just getting a preview into Group RMC's investment philosophy and just that power of co-investing of institutional quality assets. And that's something that a lot of our families are continuously looking for. Constantly looking at that diversification outside of what it is that we're seeing in the bond markets or even equity markets. We're always looking to provide diversity in investments that are complementing our traditional portfolios. And one of the things that I know when we invested within Group RMC roughly about 4 or 5 years ago is a lot of their philosophy on value-based investing. So I know one of the quotes was Warren Buffett's philosophy: it's hard to go wrong when you buy a dollar for less than a dollar. So this is something that I think is their continued value and their philosophy on how it is that they're purchasing buildings. And I'm sure we'll hear a little bit more from Anthony here today. But also, I think one of the biggest impacts that we're seeing, whether it's on the Canadian side or in the US, is what is the impact and how is Group RMC navigating the rising interest rate environment? But also, Anthony, what are your teams seeing from the opportunities going forward? So what it is that I'll do is I'll pass it over to you and we'll get an update from yourself. Thank you.
Thanks, Chris. And again, I really appreciate the time and being here. So I guess to your point, I think an important way to kind of kick off this call is just to give you a little bit of background history about Group RMC, where we come from, and most importantly, our structure. So we're essentially a real estate co-investment group. And why that's a really important point to start with is because we don't look to manage anybody's money. We look for real estate deals that we want to acquire. We'll typically put anywhere on average around 10 to 15% of our own equity into that given deal, and then we raise the remaining equity across other our co-investment partners, but which ranges from other investment advisors like yourselves and your business and your clients, as well as other families across the world, really. And the whole idea is actually quite simple. We're essentially a bunch of co-investors with a like-minded view, pooling our money together. And what happens is that if you do that, you can scale and go after much larger deals than you would ever be able to do if you were one family alone trying to buy these assets. So having that firepower gives you the ability to go after, the institutional size deals, but really we're 100% private family-owned business. And so when you start getting into those much larger deals, because you're pricing out a lot of the smaller groups, well, the metrics are just a lot more interesting. Like your cost basis becomes a lot more interesting. And as you'll see, and you kind of hear about us, and I'm sure even investors who know us already, I think it's important that they remember that they be reminded. For us, the cost basis is always the most important thing. And really, this started off just in terms of history, where we come from. Started off, a handful of families about 30 years ago during Texas and the savings and loans crisis, where it was a very isolated incident where in Texas we were finding a lot of great opportunities because a little bit of issues in the credit markets, and so we ended up buying 3,000 units that were generating $5,000 a year of revenue, but we were paying them about $15,000 a unit, right? So I mean, these within after costs and everything, even at higher interest rate environment, these things were paying themselves off within 5 years or so. And then so that was our big first push. And at that point, we were just really a handful of families, not really a business or anything like that. Very back and napkin deals. We eventually sold those to Sam Zell's Equity Residential, which is a publicly traded REIT in the U.S. And then our next kind of big chapter of Groupe RMC came post the Quebec referendum. And for those of who don't know about the Quebec referendum, it was essentially a Quebexit, which is I guess a term that's been come up more recently, which I find quite funny. It was essentially Quebec looking to leave Canada. And it didn't go through, but after the second, we had two, and after the second referendum, it got really close. So a lot of major companies, a lot of there was just a mass exodus leaving the province, going and set up shop in Cal. CN, for instance, set up shop in Calgary. Bank of Montreal isn't even set up in Montreal anymore. It's actually in Toronto, the head office. So we just had this mass exodus, but at the same time, we're finding amazing opportunities where you had your lawyer, your accountant, your doctor who's there, and they have their practice there. They've had it so for 20 years. They weren't going anywhere. But again, we're finding amazing opportunities because nobody wanted to invest in Quebec, and as a whole, as a thematic, as a theme, I should say, it just wasn't an interesting investment. But we were finding amazing cost bases. And then the third, I guess, big chapter, which we're kind of in right now, maybe towards the tail end of it, was in 2011, following the financial crisis in 2008. There was a massive dry up of credit, and so a lot of investors who were looking to buy real estate couldn't even get access to credit, and we all saw what happened, and real estate prices tanked like crazy. But again, we started buying in 2011, finding amazing opportunities, and this time much more focusing on areas where it was far away from the coast, where we're finding deals that were outside of the core markets like New York or the Silicon Valley or anything like that. And this is kind of our map where we ended up developing our footprint since 2011. The one thing I'll say about this whole, I guess the three big chapters, and also kind of what we're heading into next. Some investors look at us and say, well, it's because you're contrarian, right? And the reality is, no, it's not that we're contrarian. We really are value based, and to be a really good value investor, you can't be out there chasing momentum. You really need to be finding the best opportunities wherever they may be. And so, although there's some type of contrarian nature to that, it's really just about finding the best deals, and that's what we've done. And so we've developed our footprint. Now we're 21 million square feet. Quietly over the years, we became one of the largest landlords in several of the different cities that we operate in the U.S. We're 2.5 billion assets under management. And as I mentioned, we've never really tried to chase momentum. We get a lot of the questions, why you never got into industrial. Well, industrial is very expensive if you ask us. It's very difficult to make money from a cash on cash perspective, or from a yield perspective if you're buying industrial, because you have so much money chasing the same assets. Is this driving up bids? And so that's why, kind of looking at the map here, where we've developed our footprint, it's far away from the Silicon Valleys, the New Yorks and downtown Boston's. We've stayed very far away from those markets and just focused our efforts where we can find very attractive cost basis, where when you get in at such a low basis that you're really just making money from the cash flow, right, from all the rents that you're collecting, and because your basis is so low, well, your yields tend to be a little bit higher. So that's really where we built our footprint.
You know what, Anthony? I know I didn't mention it in the beginning, but it's also a great reminder that outside of what it is that you guys are doing, that there is alignment from partners within and family members within Groupe RMC. Can you remind me again, is the percentage of ownership? I know that there is that alignment where you guys are invested just as much as the co-investors. So Can you walk us through that again? Because I think, again, that's just a great reminder, and I didn't touch on it in the beginning.
Absolutely, it's actually a great segue into what I was going to talk about, our fee structure next. And so the way we invest is we look for deals that we want to acquire, right? And so we will then put in 10 to 15% out of pocket uh, into those particular deals. So our alignment is very, very high with our co-investors, because we're not looking to raise money so that we can go invest that money on other on their behalfs. Rather, we're looking for partners, and so we're heavily aligned. And again, having kind of this co-investment structure where we're putting in our equity alongside other investors, for instance, your investors. Well, that's what's driving that firepower, that ability to scale and go after much larger deals. So our alignment is extremely high, and it's really our co-investment structure that's allowing us to grow and have this firepower to go after the institutional style deals.
Great. Yeah, thanks for clarifying that.
Yeah, absolutely. And just kind of that actually really feeds in really well in terms of our fee structure, because again, so not only are we aligned from a co-investment perspective, because we're investing our own money in absolutely every deal, but on top of that, we take 100% of our fees in sweat equity. So it's a 6% markup on the acquisition cost that we then take 100% in units. We don't charge any management fees. We don't charge any performance fees, any selling fees, any refinance fees, or anything like that. So that co-investment fee that we take up front, that markup that we take, that's actually really important to our structure, because not only does it obviously continue on that idea of alignment with our other co-investors, because obviously if we're taking sweat equity, if we do a bad deal, we're getting units of a bad deal, so we're highly incentivized to buy right. Mm-hmm. But more importantly, why the co-investment structure is important up front, why we take it up front, is because now we're incentivized to buy. We're not incentivized to sell. But the problem is, if you're incentivized to sell, then if you look at a lot of our other competitors who charge a performance fee, if you're charging a performance fee, you're not really incentivized to get out at the right price or get out for the right reasons. You're incentivized to sell because that's your payday. That's when, if you're a manager who's buying real estate with the idea of like, I'm going to make my money when I sell, all you're going to think about is, okay, when am I going to sell? Whereas us, we're not incentivized. We're not incentivized to sell. We're incentivized to buy. But again, we're incentivized to buy right, because we're taking 100% of our fee structure. We're taking it in sweat equity. So that's why our fee structure is so important. If we were selling if we were charging our investors a performance fee, we would need to go to much hotter markets, because we would need to know that in 5 years there's going to be a market there. So it's not necessarily because we're buying because we think it's the best value. We would be buying because we know we have an exit in 5 years, so that we can collect a performance fee and churn assets. And for us, that just doesn't make any sense. We just want to be good landlords, good real estate owners, and cultivate these assets. Just be a good long-term landlord. So So anyway, so that kind of ties in, in terms of co-investment interest, alignment, and our fee structure. And the next big question we often get, because a lot, we're the family behind Group RMC, which is the Massa family, has Canadian ties. We were from the western part of Montreal, and we often get the question, well, why aren't you guys buying in Canada anymore? You guys are from here. And I like to kind of throw up this slide, because I think a lot of times investors, especially based in Canada, forget how big and how much opportunity exists in the U.S. And for us, that's really important, because we want to be going wherever we're finding the best opportunities, and that's why we've developed such a big footprint in the U.S. And just to put it into perspective, from a GDP perspective, these are all the different states across the United States labeled with a country of a similar GDP. So we're in Kansas City, has the same GDP as Switzerland. Canada as a country has the same GDP as Texas, right? That's just one state in the United States. So a lot of investors, who consider even the states that we're investing in, like Kansas City, Columbus, they consider these flyover cities, flyover states, but the opportunities are just so much more massive than anything that we're finding in Canada, right? So that's why, and it's not that we're pigeonholing these markets. We can go, again, pretty much anywhere in North America. We have a team with amazing expertise, but just so happens right now that's where we're finding the best opportunities.
Yeah, thanks for touching on that.
Yeah. I'll give you a quick update in terms of, I guess, how our portfolio has been as a whole has behaved and how that's kind of translated into, what type of performance that's translated into, and also coming out of the pandemic, right? So I think that that's important, especially that we've spent so much time buying office. We often get the questions, well, how did you guys do during the pandemic? So touching on all those things, I think is really important. But so the pandemic for us was probably one of the biggest stress tests that our portfolio has had to endure. And so I kind of put up this picture here. I find it funny because we all, there's that saying, a rising tide lifts all boats. But then it's when the tide goes out that you see who was swimming naked. And so for us, a rising tide, when everything is going up, it's easy to make money. I mean, you throw a dart and everything is going up, and you see it on the public side, you see it on the private side. You don't, the kind of that deep value, that bottom up approach is less important when things are always going up. But then when the music stops or when the tide goes out, and you see how many investors were going in, were razor thin cash reserves, trying to stretch every dollar, maximize IRR, and just really having just kind of perceived performance as priority rather than really the health of the buildings. That's really when you see kind of who's left standing at the end of it. And for us, this was an amazing test for us, but also an amazing opportunity. So our portfolio, it obviously held up really, really well. We had, maybe 99% rent collection. So our cash flow never dipped a little bit, but it was never. So talking to some of the families that invest in core markets like in Montreal or in Toronto, I mean, they were paying their own mortgage for almost a year in some cases. And so our leasing activity actually picked up. We're 1% high. We're 1% higher square footage leased than we were going into the pandemic. If we look at put aside what we bought during the pandemic, just the comparing apples to apples, what we own going into it and what those assets are, where those assets are today. But also we went in with a huge cash reserve that not only we went in with a huge cash reserve, but we actually ramped up cash reserves even more during the pandemic because we wanted to be ready, given the fact that it was going to be an uncertain period. And so all those things really helped us to weather the storm, that where our performance was relatively flat, but we kept paying out distributions to our investors. And not only that, but because we were in such an amazing position of strength, we went on the attack, right? We didn't have any fires to put out at the property level. So it allowed us to focus our efforts, and we bought 5 million square feet, almost $500 million, or actually over $500 million of deals over the past year and a half to 2 years, where we were the only people showing up to buy. And so probably some of the best deals we ever bought happened during the pandemic, which we just got those under contract, and those are going to create tremendous values, which for those investors who are invested with you right now, those are part of the real TLP. They're part of the portfolio already. And we're going to be generating a lot of value from those portfolios just because of the amazing cost basis that we got in at and the upside opportunity. So we're very, very excited about that moving forward. Did you want to talk about anything here? Because or I can keep going, but I
think more and more just hearing the high level is great, and for a lot of our families is just understanding. I think that always the question, and when we do portfolio reviews, is always, well, how is Group RMC doing, and how are they handling a rising interest rate environment? So I know that's something that we're going to cover off, but that is also a reoccurring conversation that is coming up when talking with clients.
Absolutely, yeah. So that's essentially, I was going to give kind of one case study in terms of, I guess, one of the deals that we bought during the pandemic, and then talking a little bit about what's happened more recently and what the opportunity we see moving forward. So just to touch on one of the deals that we bought, this was in January of 2020. Sorry, I should say. It closed in the summer of 2020, but we started negotiations in January of 2020, so even before the pandemic hit. And we had initially lost a bid on this. This is the Jacksonville LP. The real name of this building is actually the Bank of America Tower. It's the largest tower in Jacksonville, Florida. And so we initially lost the bid, It was another group that won the bid. They bid well above. They bid well above what we had initially went into when we bought this. And this was being sold by Hertz Investment Group. They were slowly unwinding their portfolio because the patriarch passed away. They have, I think, about, I don't know, I think maybe 10 million square feet in their portfolio, and they're slowly kind of starting to shed some assets. This was one of the first to go. So they're selling again, not because it was the right time to sell, but because they started to unwind, and it just happened to fall, right before the pandemic. And when the pandemic hit, the group that had initially bid 90 million for this deal pulled out because of the uncertainty of the pandemic. They paid whatever fees they had to pay, and then they cut their losses and they pulled out of the deal. So this deal came back online. I think it was in March or April of just smack at the beginning of the pandemic, where we were again just kind of the only buyers showing up. And the initial sell price of this deal was over 90 million. It was around 90, I think 91 million. We got this, I don't know if you see my arrow here, but $75.5 million 3 months later. No change in fundamentals, just because liquidity, cash is drying up, the sellers pulled out, and this is a very, very much a typical Groupe RMC story when we buy, just buying when nobody else is around to buy, because then we command a lot more power over the purchase price. So we got this at 75.5 million. Beautiful building. It's part of the RMC Realty LP, a part of the portfolio which you hold on book. And this was at 79% discount to replacement, and at an occupancy of 61%. So at 61%, this thing is, we bought at such a low basis that this is cash flow positive. Right, so that's a really important point to note. And right now, we bought it 2 years ago. Right now, the occupancy is up at 65%, and we're going to keep leasing it up. We have a refinance plan in the next couple of years, and that refinance is actually a pretty good transition into terms of what we're seeing next. So this is one of many deals that we bought during the pandemic. It is already part of the portfolio. Since the I'll skip to the kind of where we're seeing the opportunities next, and what the current interest rate environment is causing us. Since the beginning of the year, it's gotten really difficult to buy office for a couple of reasons. One, the higher interest rate environments have actually pushed groups that would typically be building to start buying existing, and we only buy existing, so that brought in new competitors. But also, we're starting to see competitors not only from other office investors or other office buyers, but actually multi-res investors coming in, buying office and repurposing them for residential. So now we're starting to see so much more competition in our markets that we hadn't ever seen before, because everybody's kind of chasing this yield, where interest rates have made things so expensive, where the cost of labor is really expensive to build. I mean, you see what's happening in Vancouver right now. We're starting to see buildings have built, but projects not continuing because the cost of everything's gone up. And so what we are seeing kind of the push is in our space. So we bid on, I think, 3 million square feet of deals since January of 2022. We got outbid on absolutely every single one of them, averaging anywhere between 10 to 25%. So that obviously put us in a situation. So like, we're going to stop buying. We're going to wait until things settle down a little bit. And so we started pivoting our focus in terms of where these higher interest rate environment can cause an opportunity for us. And again, we're very heavily weighted in cash, and we've always been so, but even more so now, especially because debt yields are looking a lot less interesting in the higher interest rate environments. It makes maybe a little less sense to leverage. And at least maybe for the short term, I think once credit markets stabilize a little bit, it'll be really interesting to find maybe refinance opportunities are going to become a lot more interesting. Mm-hmm. Once the credit market stabilize a little bit. But where we are seeing a lot of opportunities moving forward is the higher interest rate environment. Again, I spoke to it before. Or PMs were motivated by IRR, are very, very driven by keeping as little cash on books as possible, so you're juicing, your returns look a lot more interesting, and that's great when everything is going good. But then when you kind of hit a snag, or things start going bad, or now it's we're heading into an inflationary period, and I apologize for that. Can we cut that off?
I'm not sure if we can or not.
I'm so sorry about that. Sorry. Jesus, I am so sorry. Uh, I thought I had a nice little quiet room here. Okay. We'll keep going. So just get back into the shoot. Okay. Okay. So anyway, so yes, I apologize for that. Um, so where we are seeing opportunities now is where some REITs may have been maybe not properly managing their cash reserves, going razor thin on cash reserves, where they're running out of money, and not only that, but also the ability to refinance is really drying up because the cost of debt has gone so significantly higher. There's a REIT right now that we're looking at that has a building that's 140% levered. They have a refinance coming up next year, and they have literally zero options because they're going to essentially have to go bankrupt for that particular building. And we also think maybe that might be a structural issue at the higher level of the REIT. But that's a perfect opportunity for us to kind of go in and provide some nice injection of liquidity where that REIT will need that liquidity in the next couple of months. We're going to be there to provide that and have a nice little buying opportunity where these are for sellers. So the higher interest rate environment, I mean, it's higher interest rates are not good for any asset class, right? Whether it be equity, whether it be real estate, whether it be other fixed income vehicles, it makes things more expensive. But if there are going to be opportunities, because not so much of the underlying assets, but the structures like REITs who have gone razor thin on cash reserves and now need to find some source of liquidity, we're going to be the one to come in and take nice little chunks and be a little bit more tactical in terms of what we're buying. And it's just, and it's just starting, right? Like we're already starting to see, because the interest rates are just now starting to kick in. And we're starting to see in the next year or so a lot of groups having to refinance. And there's going to be there's going to be some really interesting opportunities coming up, which we're ready for, right? Like we're ready for, and thanks to partnerships like we have with you and other co-investors, we're going to have that firepower to really capitalize on these opportunities that we think are going to present themselves in the next few months.
So a question that comes up to mind as you're talking about this environment is you're talking about that people are overbidding.
Yeah.
So is a part of your strategy is where you guys would look to pivot to generate even more cash than where you're sitting on right now, given that there is this ability to really capture the market and sell some of these buildings? Are those strategies that you guys are considering, or is that something that is just not within your philosophy?
We're not big on selling, so it has generated in some cases short term anyway some cap rate compression, but I think once the interest rates kick in, I think we might see some cap rate increases, to be honest. And so where we're creating our value is not so much on the cap rate kind of from the bottom up, higher interest rates or cash flow, but also from the top down. Where we're creating our value is from the bottom up, right? Leasing up space, bumping up rents, and that's what we've always done. When we buy it, our value creation we don't just sit on our hands, wait for things to go up. We're creating value, leasing up space, bumping up rents, reducing expenses. That's really where we're creating our value for our investors. So we're still seeing appraisals coming in slightly higher, but as a market whole, I think we're actually going to see cap rates go up once the interest rates really start kicking in, which that's, I think, I think there's going to be more of a buying opportunity than a selling opportunity coming up. I think what we saw in this year, I don't see that. I think that's going to be short term.
So you talked about cap rates. So just for some of those investors that aren't familiar with what cap rate is, do you mind just explaining at a very high level?
Yeah, it's a very real estate specific. So you're absolutely right, Chris. It's not something that a lot of people, even investment professionals who haven't touched real estate, a lot of people don't know. But it's actually a really simple stat. It's essentially your yield on a building before, or your cash yield on a building before even putting on a mortgage. So it's net operating income divided by your purchase price before leveraging, right? So net operating income divided by purchase price, that's essentially your cap rate. So if you have a 10 cap, well, you're yielding some 10. If you have a 2 cap, well, you're yielding a 2. Markets like Vancouver, you might see. I mean, we have an investor who sold I think it was like a 0.75 cap, who invested with us. So You do see a lot of those, and we've always stayed away from those types of markets, right? Those are very much momentum-driven markets. We'd rather seek these kind of areas where you're starting to see the cap rates go up, because it means they're, overlooked or less, less loved, but with great opportunities to find if you know how to look.
So just to summarize that, from a higher cap rate, so if you're looking at something that's greater than a 6, you can expect to have a greater yield, and it's paying out better distributions.
Correct.
Potentially to investors. Yeah, great.
Correct. Yeah.
I just want to be conscious of time here.
Yeah.
It is. We'll try to wrap it up as quickly as possible. Any last comments from you, Anthony, that you think are important to vocalize to investors here in this quarterly update?
I think for now, we touched on the major ones, which was, again, the rising rates and kind of where we're going to be focusing in the next couple of months. I do want to say thank you again. It really is because of partnerships like the ones that we have with you. The teams that are looking to not just buy what everybody else is buying, but do the proper due diligence, because that takes a lot of time on your part. And so I just want to thank you for the opportunity, and also just having the ability to speak directly with your investors.
Perfect. Well, again, Anthony, thanks for your time here. We look forward to the next update. And again, we're trying something a little bit new with some of our partners like Group RMC. So if any investors have any additional questions, feel free to reach out to me and I can pass it on to Anthony. One thing that's great about Group RMC is they are very responsive in getting any type of request or questions from our families. So I'd encourage you to reach out to us. But also, in addition to this video, we will have an update just for everybody to read in addition to what we covered off here today. So again, I want to thank you for joining us here today, and we look forward to the next update. Thanks, everyone.
Thank you. I'm so embarrassed.